Okay, good evening, everyone. Just a quick sound check. Speaking of which, I need to turn off my speakers here. I'm getting an echo. Okay, just a quick sound check. Can everybody hear me okay? Okay, everybody can see the screen okay? Perfect. All right, so where's everybody joining us from tonight? We've got a pretty good attendance here for a Thursday summer night. Jay from Australia, welcome Jay. Doug, hi Doug, I recognize you. Stephen from Australia, hi Stephen. Ivan from Perth, Australia, hi Ivan. Thanks for joining us. Wayne is from Ajax. You're pretty close to us, Wayne. Thanks for joining us tonight. And Doug is from Doug. Hi, Doug. How are you tonight? It's been a while. It's been a while, my friend. I hope you're enjoying your summer. Okay, very good. Okay, so, okay, let's get started. Marcel's in Sarnia as usual. Not going anywhere too soon. Sorry to hear that, Marcel. I don't think there's much going on this summer at all in terms of travel. I know we don't have any travel plans either. Hopefully we'll get our meetings going back in September, and we'll be able to get together and hang out. And then close to Christmas time, hopefully people can start traveling a little bit easier. Okay, gang. So just waiting for a few other people to join us in the room, and let's get started. Okay, I'd like to officially welcome you to the Systematic Investors Group Supercharged Momentum Trend Strategy session presentation. So we'll be going over the rules and the backtest results of the Supercharged Momentum Trend Strategy, our implementation that you can start using to get trading ideas as soon as tomorrow morning. So sorry for the disclaimers right at the start, everyone, but it needs to be said. Trading and investing can contain significant financial risks. This presentation and all references are subject to the disclaimers as posted on our website at www.systematic-investors.com. Please take a moment to visit and read through the disclaimers on our website before considering use of any of our services. All traders and self-directed investors are always responsible for managing their own risk and making their own final decisions. So please use all information presented at your own risk. We're going to be specifically talking about backtests, trading signals, things of that nature. So absolutely use all information presented at your own risk. None of this is meant as advice of any kind. All right, as Jay-Z says, men lie, women lie, numbers don't. So let's keep that in mind later when we go over the backtest results. You might recognize that guy on the right there. He's a pretty good investor. So hey everyone, my name is Dave DeMarcantonio. For those that don't know me, I'll cover just a bit about myself. I'm a long-term student of the market since 2006. First placed my trades in the dot-com era when online brokerages started to become a thing. I'm an independent do-it-yourself investor in both financial markets, and I do some commercial real estate investment. I ran a small trading room between 2011 and 2014, many related weekend meetups for traders. I was a local Canadian Society of Technical Analysts chapter head. I ran the monthly meetings for about 3 years, and I was 2 years on the CSTA board of directors. I'm still active in my local CSTA chapters. So I just wanted to let you all understand that I'm active in the trader community and the investor community, and I understand the struggles of short-term traders and longer-term investors quite well. Now, as with anything, I think it's important to manage expectations. So trading and investing is not get rich quick, but you can do quite well over time. You benefit from treating trading or investing as a process. It's a process towards building long-term success and wealth. It's what I would consider another stream of income. Everyone has big trades from time to time. We may show you some that we have on right now, but you can also have big losses. Not every trade will be a home run. You can't possibly know which ones will be big winners or which will lose. So you can't risk big on every single trade or you're going to blow up. You know, that's just the reality of it. So don't get fooled by the hype out there. There's a lot of hype out there. Position sizing and risk management is paramount to longevity. Now, for every presentation should have stated goals and objectives. Here are the goals and objectives of this webinar. Excuse me. So we're going to review the supercharged momentum trend strategy. We're going to look at its background, where the supercharged momentum trend strategy fits on the trade spectrum. We're going to look at some preconditions. We're going to look at some implementation rules, or the setup of the actual setup of the trading strategy. What do real trades look like? We're going to have a look at what some real trades look like, both winners and losers. We're going to review the backtest results to answer the question, does this strategy have a positive edge? And spoiler alert, yes, it does. Otherwise, I just wouldn't waste your guys' time tonight. So how you can automate the strategy, we'll talk a little bit about that. And where you can find free daily trade signals for the supercharged momentum trend strategy to get you going as soon as tomorrow. So a little bit about the background, and just for those that may be on short time, this presentation is going to last about an hour tonight, plus questions. So a little bit of background, the supercharged momentum trend strategy is based on a simple technical analysis concept, and that is the moving average crossover. In this case, we're using an exponential moving average crossover. The moving average crossover defines both the trend and the momentum condition. And the strategy essentially focuses on a short-term positive EMA crossover condition that defines a short-term uptrend, that a short-term uptrend exists, and that momentum is positive or pointing higher. So it fits within the momentum and trend categories of strategies, and the idea that the trend is your friend and momentum or trends persist long enough to have an edge and be profitable. So the strategy finds a short-term momentum and trend shift condition in an uptrend typically after a recent pullback condition. The expectation is that the uptrend will continue after the pullback, especially after the momentum shift, aka the crossover, has taken place. After the momentum and trend shift, or the crossover, momentum and trend are expected to persist on average long enough that an edge might be found as a result of the real world application of the strategy rules. Now, just a little side note, for years, I always looked at moving average crossovers and I basically dismissed them. They seem too simplistic. They're one of the first things that you learn most likely as you get into trading and technical analysis specifically. And one of the tricks that actually makes it work is the application of it into a systematic process and using an actual portfolio. So we're going to get a little bit more into that. So, but before we do that, a robust trading plan benefits from the diverse characteristics of how markets work. Here's a visual that shows 3 different characteristics and types of strategies that can be used to balance out a systematic investor's entire portfolio. Now, we're missing a couple of things on this list, such as volatility and seasonality, which we'll be adding in the future. But this is just the basic framework. So from left to right, you've got a shorter term strategy that exploits the fact that markets pull back before they move higher. The RSI2 strategy that we covered in the last session fits that criteria. And then we have a midterm strategy that exploits the well-documented momentum phenomenon of the market. So for example, you could have a monthly momentum rotation strategy or other type of short to midterm momentum strategy. And then finally, a longer term strategy that capitalizes on the momentum phenomenon further and the fact that markets trend over long periods of time, typically in the longer term trend following category. So the supercharged momentum trend strategy fits somewhere in the middle within the second and third categories that you see here. It is both a shorter to midterm momentum as well as a midterm trend following approach. Now, in terms of our strategy, we focus on long side trading only and not short side trading for this strategy. Why? Well, some stocks are hard to borrow short, and there's no guarantee of consistent fills when shorting. And as well, the market has a positive drift bias. It goes up, approximately, depending on who you speak with, 57% or more of the time. When markets get volatile, some countries or exchanges have been known to even ban short selling. And it's actually very difficult to come up with the rules for a strategy that shorts and achieves consistently profitable results. Not just, I'm going to implement this strategy under a certain condition of the market, but implement it across the board every single day so that it achieves consistently profitable results with decent or reasonable constant exposure to the market. So bull markets, as we know, last much longer than bear markets on average. I think we saw that even recently with the coronavirus sell-off, where we had that crazy V bottom, which was quite unexpected. All right, some preconditions. Excuse me, our trading universe is going to be the S&P 1500 current and past. So that is the 1500 stocks that comprise the S&P 1500 index today, and the 1500 stocks that comprise the S&P 1500 in the past on any given trading day in terms of the backtest. So the max number of portfolio positions is going to be 20. This is what we're going to refer to as portfolio-based position sizing. We're trading a portfolio of stocks and allowing up to 20 portfolio positions. So for the total capital allocation to the strategy, each position is going to be equal weighted 1/20th of the total portfolio allocation. So for example, if we're allocating 20,000, we're going to have a 1,000 max per stock position. All right, let's talk a little bit about some more preconditions, regime filters, and ranking. This strategy uses a simple macro regime filter for market timing. So we have the SPY has to be trading above its 95 EMA on a closing basis. This market condition has to be true in order to allow buy signals at all. Signals also are ranked. So in the case of too many signals versus the number of slots available in the portfolio, some signals are given priority over other signals based on the ranking algo. We don't disclose the algo, but generally speaking, we're going to favor lower volatility stocks. Now, the supercharged momentum trend strategy is an end-of-day strategy. It does not use live intraday market data to make decisions. So essentially, you stay out of the fray and you will own the day. You stay out of the day-to-day intraday volatility. Trust me, for those that aren't doing it right now, end-of-day trading, you will own the day. All decisions are made after the market closes. Execution takes place the next day. Entries are market on open, and exits are also market on open orders. So live orders should be in the market on average, depending on which market you trade. Since we're trading the S&P 1500, they should be in the market at least 15 minutes before the open so that they get matched and executed and accepted, not rejected, but accepted for the open auction process. So I think the NASDAQ's a little bit different. I think you only have to be in the market 10 minutes before the market opens. But for the S&P, at least 15 minutes before the market opens. Opening prices should match up well with your back testing and your charting software. So when we're using market on open orders, if you look at, where you got executed, the opening price of the bar on the daily chart should match your execution price. So all buy and sell rules wait for confirmation of closing prices and conditions at the end of the day for execution next day. So we have a one-day trade delay. So why do we do this? Well, essentially because this allows for practical and realistic expectation and execution. There's no look-ahead bias. There's no difficult to execute trades. If you're doing this manually, which I do not do, but if you're using this strategy manually and just looking at the strategy signals that we're going to show you a little bit later on, that you'll have access to for free, essentially you can execute your strategy at the end of the day for the open the next day. Now, we post our signals at 4:30 a.m. Eastern time, so anytime before, before 9:15 a.m. and between 4:30 a.m., you'll have access to those signals. All right, so here's our buy rules. The 3-period EMA has crossed above the 8-period EMA on a closing basis. There's your short-term momentum and trend shift. The stock has to be above its individual trend filter, its respective 150 EMA, in order to be considered a viable trade. Now, we're also going to use a couple of other things to improve the performance of the crossover. We're going to look at the range on the buy bar. It has to have expanded by more than 25%. The volume has to have increased on the buy bar by at least 10% over and above the 20-day volume average. So essentially what we're doing is we're looking for a crossover, but we want a little bit more confirmation that, there is actually some real buying interest in this stock and that the momentum and price is going to follow through to the high side. It also has to be a constituent of the S&P 1500 index today. And for back testing, it has to have been a constituent of the S&P 1500 at the time of purchase and not within 2 days of being delisted. So again, we're going to buy next day, market on open when those conditions are true. Excuse me. Now, in terms of our sell rules are really simple. So for our profit target and our stop out, we're simply going to sell when the 3 EMA crosses back below the 8 EMA. So as soon as the short-term momentum and trend shifts lower, we're out. We're also going to close if within 2 days of having been delisted in terms of back testing, and in terms of our live testing as well. And we're going to sell the next day, market on open, as long as the sell condition has been met at the close of the previous day, or the current day rather. So here are some recent live money trades as of this past Monday, July the 20th, when I was finishing up the presentation. They're all sorted by percentage gain. In fact, the first couple of trades I think I still have on, and they really haven't moved much from there. So as you can see, some of the trades can really run up in price. And the losses with this system are fairly contained. They're pretty well contained. So when the momentum turns lower, the trades are exited. This strategy really takes advantage of the old adage, let your winners run and cut your losses short. And this is a simple way to stay in the trade. So you can see here, like MED, this trade is still on. I think it's up about 40% today still. LMNX is up 20%. SAM is up. I think SAM is up around 15% still, 10 or 15%. With these strategies at the end of the run, they usually run up and there's always a little bit of give back. So that's something you kind of have to get accustomed to with this trading style. So for example, when MED cashes out, it might give back 5%. Excuse me, it might give back 2%. It might give back 10%, something like that. So you have to be prepared for those that give back. It's similar to how a trend following system has give back at the end of the bend at the end of the trend. But this happens a lot quicker than a long-term trend following system. Okay, so here was the screenshot from Monday. When we get to the back test, we'll look at some of the charts as of the close today. But you can see here was the entry. So the cyan triangle is actually showing you the trigger bar. So you can see on a closing basis, that's when the crossover took place. And then we buy the next day on open, and we're still in the trade. Here's your 150 EMA. We're obviously trading above it. Things are looking good. LMNX, here's the other example. This trade is still on. Here's your crossover bar. Here's your, you get in on the open on this little, on this bar with the green arrow. And, the back testing software shows that you're getting out, but that's just because it's the last bar on the chart. So we're still in that trade. Here is SAM. You can see Sam here is still in the trade. It would have got, here's the signal bar. Here is the actual entry bar on the open. And this one is actually still in the trade as well. So as you can see, the supercharged momentum trend could essentially be considered somewhat of a swing trade, where you're attempting to capture swing move from a relative low to a relative high in the market, or a move after, from after a pullback as it resumes momentum until it loses relative momentum again. It's not necessarily from an absolute low or an absolute high. It's not necessarily a swing in terms of like what the RSI2 trade was for those that were with us the other week. But it is a relative swing in the market. So it fits the criteria of a trend and momentum style trade. So Ivor says, thanks, Dave. Could you please clarify what is meant by range on buy bar? Also, does the system ever use limit orders to avoid opening gaps? So we're going to get to the opening gaps in the next slide. Ivor, welcome, by the way. The range on the buy bar is based on the average range. So for example, the average true range of the bar over a certain period of time, you want to see that the current bar on the signal bar has expanded beyond the average true range over the last X number of days. That's essentially what I'm referring to. Okay. And oh, sorry. So we don't use limit orders on this strategy. Every strategy that we develop is a little bit different. This one uses market on open orders. We could also use market on close orders. We just choose to use opening orders. Okay, so here's an example of a loser. Now, the biggest challenge with this strategy, and why a lot of people probably don't do well with moving average crossovers in general, is because if you're trading it as a discretionary trader, look at all of the chop that you get in a lot of trades, right? And you'll see with the win rate that, you've got a less than 50% win rate. So this is a kind of trade that discourages most traders. Now, if you're a systematic trader and you understand the statistics and you understand, yeah, you know what, I'm going to get into some of these trades, I'm going to get chopped around a little bit, but the ones that run are going to make up for the losses, and you can just exploit that process and understand the statistical edge of the system. And, this is one of the reasons why I personally automate my trades, because I just let it run like a process, rinse, repeat, rinse, repeat. So you can see here, this is a typical losing trade where you get a little bit, here's your pullback, right? You got a gap up situation. I don't have the volume on here. I don't know if this was a professional gap, but you've got this gap up situation. It pulls back. And then once it's ready to start moving higher again, it starts moving. Then you get like, a big down bar, you're out of the trade. Now, this didn't follow through to the downside. It likely could have been a profitable trade, but according to our rules, we're out of the trade. But you do get a lot of chop like this, and that is the challenge in trading a strategy like this. If you're going to be a discretionary trader, there's a reason why we trade 20 positions at a time, because it's just a numbers game, guys. It's simply a numbers game. So you just want to exploit. You've got your positive expectancy. You're going to make, let's say, on average, almost a percent per trade, and you just rinse and repeat. So you can see, like, for example, if we were to have gotten into this trade, it would have gotten out somewhere around here. It would have been profitable. So you're going to win some and you're going to lose some. So here's another example of the same kind of loss where, we didn't really break the relative lows. We're still in an uptrend, but we're essentially out of the trade and we're on to the next trade. So this is PETS. This is a recent trade. And this was a recent trade that I specifically picked trades that my automated system actually took. Okay, now here, this is what Ivor was referring to. So here is a gap down situation where there was a 30% loss overnight. So here's an example of what would probably be most likely with this trade setup, one of the worst case trade scenarios. And this is why we adopt the position sizing approach that we do. This is one bad trade, or this one bad trade didn't do a lot of damage to our account. So while this specific trade had a 30% loss due to a gap down situation, the strategy has about a 16% maximum drawdown and more likely a 10 to 12% average maximum drawdown during the same time. So even with this type of gap down trade included, for example, during the recent coronavirus sell-off, this strategy was able to contain losses to 10% or less, which we're going to see in the back test. This is important because most market participants aren't able to stomach drawdowns of more than probably 15 to 20%, I would gather. And that's myself included. You know, if I've got a strategy that starts giving back more than 15 or 20%, I get really nervous. So aside from maximizing profits, we really believe that managing risk and managing drawdowns should be one of the primary concerns as a systematic investor. In fact, that is my primary concern, to protect my capital over and above making a profit. So when you first start out trading, for any new traders out there, you might be thinking, I wonder how much I can make from this strategy. I always look at a strategy and say, I wonder how much I could lose from this strategy, because everything above and beyond that is just, it's all upside, it's all gravy. But managing risk is first and foremost. So sure, some stocks in the market in general eventually recover, but not all stocks do recover, even if the market eventually does recover. So remember, some stocks go to single digits after having traded double or triple digits, and some even go to zero. So managing position size as a percentage of your portfolio and managing overall risk is absolutely key. So you can see here when, you know, we were up a little bit. If we looked at the maximum favorable excursion, we were probably up, you know, 5% or something, maybe a little bit more. And, you know, then all of a sudden, boom, we have a gap down situation. If this was our only position in our account, boy, that would have been a real kick in the butt, right? And then you see the next day, we stayed out of the fray, out of the daily volatility, and we waited till things settled. The next morning, we just got out of the trade and we exited. We exited with, I'll say, with class, because we didn't hold on to this trade and watch it go lower and, you know, go through that emotional roller coaster ride. We're a systematic trader, we're out of the trade. Okay, so let me just take a quick drink here. Now, our backtest assumptions, our initial capital is going to be $100,000 account size. We have 20 maximum positions as mentioned, and as mentioned, 1/20th equal weight per position. We're only using daily bars here, guys. We're only using daily bars. That's our time frame. Most of the strategies that we deal with are based on daily bars, unless otherwise stated. So our back test is going to go from January the 1st, 2000 until present, approximately 20 years. Again, our universe, S&P 1500, current and past, using index constituents. We use Norgate data. For those of you that are familiar, it's probably the best data out there for this type of testing. And for the back test, we're not using any commissions. The strategy obviously is profitable with commissions. Now, we're using a portfolio approach. So the portfolio approach is used rather than just trading one instrument at a time. So it assumes that when spots open up, the next available trade setup that is matched and ranked will potentially fill the available spot in the portfolio. Now, currently the back test assumes same day. So when you're doing the back test, it's going to assume that it gets filled the same day that you get out of trades. Whereas my real world strategy scan signals may have a 1-day delay when the portfolio is currently full. I'll explain a little bit about that later in terms about how I specifically implemented it. I think I've been convinced to change that. We can easily change the implementation, and we'll talk a little bit about that. So my colleague Dan has talked a little bit of sense into me about that, and we'll talk about that. So there's many different symbols used. There's less chance to curve fit when using a portfolio approach versus one symbol. It's just a more robust approach, and it diversifies risk. So the portfolio backtest approximates what would have happened from the start date if trading proceeded in a continuous manner. So it mimics real world conditions. Portfolio trading, in our estimation, equals better risk management through position sizing, larger sample sizes, more opportunities, diversified risk, and is just more robust. So here are some of the key backtest metrics we're going to look at. Obviously, you want to um, you want to see, a compounded annual return that makes sense. The highlighted ones are the ones that I tend to focus on, at least initially, the most. I especially focus on the maximum drawdown and the CAR MDD, or what's also known as the MAR ratio. It's my what's known as objective function, in the words of Dr. Howard Bandy. That is my subjective measure of a metric that is important to me and that I use to make my key decisions. So, we're going to obviously look at the compounded annual return. We're going to look at the exposure percentage, risk-adjusted return, total trades, average profit loss, which is essentially your expectancy percentage, your average profit divided by loss percentage. That's essentially your expectancy. So if somebody says, "Hey, does your strategy have a positive expectancy?" You essentially want to look at that figure, and that will tell you, whether it does have a positive expectancy between its winners and losers on average. Now, winners obviously want to look at our win rate, our maximum drawdown, CAR MDD, as mentioned, our payoff ratio. We're going to look at the portfolio equity curve, underwater equity, and profit table. So I like to keep my back testing simple. I know, there's some people online here in the systematic community that are quite sophisticated and complex. They look at a lot of different metrics. I tend to keep things fairly simple. I do at times, analyze systems at much deeper levels, but when I'm just trying to figure out if a system makes sense, this is what I look at, and I think this is a good kind of litmus test of things to look at in order to determine if you want to dive deeper into a strategy and its results. All right, so let's review the strategy backtest reports. So let me just pull that up. Now, what I've done is I've loaded this into a browser so that I can zoom in and you guys can see the figures, because the reports can be a little bit small. What I've done in this case, I may have forgot to put any emphasis on this in the last RSI2 presentation, but we should be comparing our strategy to a benchmark. In this case, what I've done is I've compared it to a buy and hold of the SPY. Okay, and I included the SPY because instead of the, I'm sorry, so what I wanted to make sure is that it's including dividends. So I included the SPY so that, the returns are a little bit better with dividends. All right, so as you can see here, our initial capital is 100,000. Our ending capital, almost 1.3, almost 1.2 in terms of profit over the 20 years. This is a pretty good system. It's in the market about 70% of the time. So the exposure is actually, quite good. Our annual compounded returns about 13% versus the SPY, which is around 6%. And the risk-adjusted return, because our exposure is about 70%, is about almost 19%, which is pretty good. Now, we've got a good sample size of trades here. We're about 6,400 trades almost. Our average profit loss, our expectancy is it's almost 1% between our winners and losers. So it's about 0.85%. With commissions, it's going to be a little bit less. Our average bars held is about 12 bars. So you can see it's kind of a shorter to medium term strategy, or at least the way that I would categorize strategy. Now I'm just going to take a look at the questions. Jay says, "Sorry guys, I have to leave, internet issue." Okay, no problem, Jay. You can catch the recording. I'll send that out to you. Let's see. Okay, so our winners. So we only win about 40% of the time. So for those, I know as a discretionary trader, if I can put myself back and go, through the time warp, as a discretionary trader, I would not look at strategies if I thought they would only win 40% of the time. I always wanted the best of both worlds. I wanted that 90% win rate, and I wanted that, the big winners. That, for those that have been on other presentations that I've talked about, the two types of strategies, or the two types of strategy results that you typically get. Now that I understand that, this is an acceptable win rate for me. I'm good with it. And this is why I have a systematic process, because I just let it do its thing. I don't really worry about the win rate. I just let it, exploit its edge every single day. Now, our average profit for our winners is about 6.2%. Our average bars held for our winners is about 20. So this is, each trade is on average about a month. Our max consecutive wins, 15. Our largest bars in win is about 27. Now, when we look at our losers, so we've got about a 60% loss rate. You can see our winners are almost twice the size of our losers, which is great. So our average loss is only about 3%. Our average bars held for our losers is only about 7 days. So we turn our losers over fairly quickly, and we let our winners, run for those average 20 days, which is good. Now, this is why our max consecutive losers in a row in this portfolio backtest is 24 losers in a row. This is why it is so damn important to position size properly, because if you hit a string of losses, there's your risk of ruin right there. You're gonna blow up your account. So it's very, very, very important for anyone that is thinking of looking at this strategy. It's very important to follow our guidelines for proper portfolio position sizing. Now, our largest, the number of bars in our largest loss was 10. Don't really care too much about that. Our maximum system drawdown was about 16%. So we're right in and around that area where most traders can tolerate at least what the maximum drawdown that this system has experienced over the life of the backtest. So like I said, when you get to around 15 or 20%, it gets a little bit dicey. People start to freak out and run for the hills. Now our CAR MDD is 0.8, which is fairly respectable. I'm just going to skip to our payoff ratio is about 2. So, we can see that, we make about 6 on average. We lose about 3 on average. So our payout ratio is a fairly respectable 2. Okay. I'm not going to cover the other metrics because frankly, they're not ones that I really give too much importance to as I'm going through my initial analysis of a strategy. So let's have a look at our equity curve. Our equity curve looks pretty good. Maybe that's a little bit too big. You can see it has flatline periods where the regime filter kicks in, these little flatline periods. You can see it has pretty good run-ups, and then it has some quick drawdowns. We just had a run-up, a little bit of a drawdown. We're having a run-up again. So the equity curve looks pretty good. You can see here in our underwater equity. So the coronavirus, I wish I could actually expand this out a little bit and see the months, but you can see our recent coronavirus pullback. I think we had just less than a 10% maximum drawdown. And you can see the last 5 or 6 major drawdowns were all contained around 10% or less. I think this one went to 11 or 12. Our maximum drawdown happened somewhere in between the end of 2011. And you can see here we had a couple of larger drawdowns, during the dot-com era here, which was a respectable, 14% considering what was going on there. So if we look at our profit table, I like to see mostly black in the years. Once in a while you're going to have a losing year, but you can see that these years, the losing years were contained. They were essentially flat. And then the last couple of years, you had 2018 was fairly disappointing. I consider 2015 a difficult year to trade. It did okay. 2017 had a good year. 2016 was respectable. It beat the market. It beat the benchmark of the SPY. And then last year it did fairly well at 14%, which was around the average. This year it's up a little bit and it's doing okay. In my account, essentially, I had about, in my live trading account, with the account that I'm running, the RSI2 and this supercharged momentum trend, I had about a 12% maximum drawdown. And now I hit a new equity high again. So I'm back up to the new watermark, and I'm positive on the year again. So that's how that's been working out for those two trading strategies. I personally like combining these two strategies because they seem to complement each other fairly well. And that's why I offered both of these strategies for free, so that for anyone that wants to start systematic trading, they can be a little bit more diversified, running more than one strategy, and the two complement each other fairly well. So there was a strategic reason why we're offering these two strategies to begin with: the RSI2, which we covered in the last meeting, and the supercharged momentum trend, which we're covering now. So here's the profit table. And I mean, that's essentially what we're looking at. Now, if we just go back to the statistics, we can see, like, I want to just highlight so when we look at our maximum drawdown and we look at a return, so let's look at our average compounded annual return. We've got 13% versus 6% for the SPY. And then if you look at our maximum drawdown, I think this is where it really shines, right? You've got a 16% drawdown, and the SPY had a maximum drawdown of almost 55%. I think the NASDAQ was even bigger, around 60, I want to say 68 to 70%, 75%. Can't remember off the top of my head. But this is something that is a very hard thing to argue when the SPY has like a stellar year. When the SPY has like a 20 or 30% year, and it just seems to be straight up, and most people just say, hey, why don't you just buy the index, and you don't have to be in and out, you don't have to worry about commissions, it outperformed everything. Yeah, it does that. It does that from time to time. And those years, systematic strategies are very, very difficult in terms of outperforming the market. That it just doesn't happen. But in most years, and over the long run, which is what you want to look at, and on average, you're going to get better results with a systematic strategy on a year-over-year basis. On average, you're going to get much better risk-adjusted returns. You're going to get much better risk management, right? Because you've got 16% versus maximum drawdown of 55%. It's like night and day. But if you don't look at the full picture, which a lot of new traders don't, that's a point that's obviously missed on them. All right, so let me just start up the presentation again. We've got a couple more slides to cover. I just need a quick drink here. Okay, now, so as we've seen, this particular strategy falls into the lower win rate, higher payoff ratio category of results. This isn't completely unexpected, since it's a short to medium term trend following-ish type of momentum and trend following-ish trading strategy. So whereas the RSI 2 strategy fit, in category number 2, where you had a higher win rate, I think it was about 60%, and a lower payoff ratio, I think it was about 0.85%. With this strategy, you have an actual lower win rate, and you have a higher payoff ratio. So this is more typical of what you would see, with trend following, with strategies that are more towards the trend following spectrum of strategies. With a trend following strategy, you might even have, a longer term strategy, you might have a win rate of, let's say, 30 to 40%, and you may have a payoff ratio of, 2.5, 3, 4, maybe even 5% if you've got a really good strategy. Okay, Jim says, Dave, I appreciate your perspective and understanding. Thanks for your insight. Thank you, Jim, and thanks for joining us tonight. Appreciate it. Okay. So now, for those of you that are interested or are already into automation to manage the day-to-day execution of your strategies, before I get ahead of myself, mark your calendar for next Thursday, July the 30th. I've invited the team at Alera Trading to do a full webinar. It's going to be about an hour on Alera Portfolio Manager. So for those of you that want to understand what Alera Portfolio Manager is, what it's capable of, this is one of the key tools that myself and the team at Systematic Investors Group uses. I use it, Dan uses it, I see Gary online tonight. Hi, Gary. Gary uses Alera Portfolio Manager as well. He's part of our community. If you're interested in understanding a simple way to automate multiple strategies, portfolio-based strategies, you're not going to want to miss next Thursday. So that's just a quick plug for that. So for those that are interested in managing the day-to-day execution of your strategies, so myself and the team, as I mentioned, at Systematic Investors Group use Alera Portfolio Manager, or APM is what we call it for short, to manage our live trading. The trades aren't always exactly synced with backtest results, as you can see from this slide. This is my live versus my my backtested results as of Monday, right? So trades aren't always exactly synced with backtest results. It depends on when the backtest starts and when your live trading starts, and due to other real live market condition factors, such as how you actually generate your signals. But typically, if you start your trading system after a period where your strategy gets you out of the market and then starts back up again, trades will tend to sync up again. So a good example was the recent coronavirus sell-off. This strategy went 100% to cash. It stopped trading for a while, and then it started trading again when conditions improved. So everything synced up for a time again. So let's take a look at the trades shown as open longs in Miami Broker backtesting software versus real positions I had on that were being managed by Alera Portfolio Manager and trading the strategy live with real money. So this was as of this past Monday, July the 20th. So we'll see that the trades that sync up are very close on a percentage basis, which is what you would hope to see that. So in this example, it appears that 5 live trades are different in my backtest versus my live trading. So all the ones that are crossed out in my live trading are, they don't match up. So you can see that CAG, the real-time percentage gain was fairly close. FDS, 5.25 versus 5.32. LII, 4.75, 4.8. So you get the idea. I won't go through all of them. You can see these trades still on. So MED was up 43%. My live account was up 42. LMNX 19 versus about 18. So you can see that they line up. Now in my live implementation, what I do is, because I'm using a margin account, what I do is I actually give it 2 extra positions. So typically in this strategy, no, I'm sorry, I'm thinking of the RSI too. So essentially they just don't match up for a couple of reasons. Now, the biggest reason that they don't match up is the way in which I decided to generate my signals. So right now, when my portfolio is full and I receive a sell signal, there may be a 1-day delay before filling those vacant positions. So for example, if I have a portfolio of 20 positions and have a signal to sell 3 of those positions on Monday morning, APM won't recognize that my portfolio only has 17 real world positions once I sell those 3 positions. So it actually calculates it going into the trading day. So as a result, until the positions are actually sold. Whereas the backtesting engine will make those assumptions right away so that the 3 empty slots get filled the same day in backtesting simulation. So in real live trading currently, APM will buy the next 3 open positions on Tuesday so that signals will actually be different. Because these are impulse type signals, I'm not using state signals. So I'm only going to get buy signals when the crossover has actually taken place, not if the crossover persists, right? I want to get it right at the beginning. So I use an impulse signal versus a state signal. So when those positions are exited Monday, because the portfolio then only shows 17 positions, so there's currently a 1-day trade delay when the portfolio is full in order to accept the new trades versus what the backtesting engine will do. So this is more a function of how I specifically decided to manage my positions and my signals. I'm not concerned about the discrepancy because the strategy is robust and the end result may be slightly poorer performance, but could also mean slightly better performance as well due to what we refer to as signal luck. So I'm personally not super concerned that my backtest positions match my real live trading positions. I'm more concerned that my live strategy continues performing in alignment with the backtest results. Now, having said that, in order to get around this, and this is something that Dan is suggesting that I do, my colleague Dan, who's part of our community, um, and so in order to get around this and to better mimic how the backtester behaves and thereby getting the strategy closer, if not 100% synced to the backtest results, we would simply need to change how our buy and sell signals are generated and use the screener method in Alera Portfolio Manager. So it's actually very easy to do. We just change like 2 or 3 lines in our code, and we change the settings in Alera Portfolio Manager to use the screener settings so that they will actually exit the 3 trades and refill those 3 trades on the exact same day. So that's just a function of the way that I've set it up. So this would, in this example used, it would sell the 3 positions on Monday morning and at the same time replace those missing 3 positions on Monday morning as well in real live market trading. So this would better mimic the backtesting engine. So there wouldn't be a 1-day delay to fill the portfolio again when you have both buy and sell signals on the same day when starting with a full portfolio already using the screener approach in APM. Now, if you have a robust trading system, these discrepancies don't or shouldn't matter too much. You can get slightly better or slightly worse results just based on signal luck. So what might matter to some, though, is better syncing of backtest versus actual results and having slightly higher exposure by filling the empty slots a day sooner. And both are totally valid depending on what the individual trader, the individual systematic investor prefers. So as mentioned, I'm more concerned that the strategy continues to perform in alignment with the backtest results, because if the strategy continues to perform as expected, but not with the exact same backtest signals, this is another check that tells me, and that tells any systematic trader or investor that your strategy is robust and it's not performing just due to signal luck. Rather, it has a valid underlying methodology with an edge. So by the way, as I mentioned, we'll be talking more about Alera Portfolio Manager and automation use cases, specifically automation use cases, next Thursday, July the 30th at 7 p.m. So for those that are interested in real live trade execution and automation, mark your calendar for next Thursday evening. And also make sure that you're signed up for a free account on Systematic Investors Group and part of our mailing list to receive the webinar invite. So stay tuned for the announcement, register for the webinar if interested. Even if you aren't able to attend in person, we'll send you a copy of the recording if you're registered. Systematic Investors Group is hosting the event, but Alera Trading is actually doing all of the presenting. So there's been so much development on the automation front. It should be a great webinar. I think you're all going to really enjoy it. And honestly, I'm personally behind on the development cycle, and I need to be educated on what's actually come out in the last couple of months. The development cycle's just been wild. It's just been crazy. Now, by the way, you can test drive this same exact strategy for free using our strategy scans, plus a paper trading version of Alera Portfolio Manager. To find out how, just visit the highlighted link here at systematic-investors.com/APM-integration. The videos on this page will walk you through the exact steps on how to set up the RSI2 and the supercharged momentum strategy, so that you can pull the signals every day and just trade it in a paper trading account and see how it all comes together. It's super cool how it all works. It won't cost you a thing to try it. I like free. Does anybody else out there like free? Could you just type free in the chat box if you like free? Okay, so we have a question from Ivan. Dave, when you change to screener type in APM, will you be sending out an email to all of us to change our settings? Absolutely. What I'll do is Ivan, because I know you're signed up for the strategies, I will update the website. I'll send out an email before we actually change everything a day before to let you know that it's going to be time to change your settings. I will, yes, absolutely. I'll cover all of that. Okay. Now, having spent so much time over the past 14 years with other do-it-yourself traders and investors, I'm now convinced that most will never succeed without their own systematic strategies, such as the one we just covered, plus their own systematic process. I know some traders because I network with a lot of traders that are very good. Um, they have very good instincts, and they're good day traders. They're good swing traders, but they, in my estimation, I've met tons of traders over the years, especially when I had my trading room floor open between 2011 2014. It was an experiment to meet other traders and to learn and grow with a like-minded group. I can count probably on one hand the number of traders that I know that just have good instincts. They're able to stick to their strategies, and they're consistently profitable. I can count on one hand. Now, I will compare that to a lot of investors that I know in the real estate community, and a lot of those investors have actually done quite well over the years, because especially in Canada, real estate has just gone through the roof, and they've done well. I don't know a lot. I know some of them, like I have friends in the real estate community that have lost hundreds of thousands of dollars, and they've come back and they've made it all back and more for those that have actually lost money. Now, that's just because of the bull market that we had in real estate. Now, if I look at actual traders, I know very little, a very little amount of traders that have actually been successful without using a systematic approach. And there's a reason for that. I mean, everything goes against you. Your emotions, your ability to just stay consistent, your energy levels. I mean, there's just so many things that work against you as a trader. And I mean, the only way I was able to stay in this game was to become a systematic investor. So quant and algo is just another name for systematic investment. Here are just some of the people and firms that employ their own systematic approaches. Okay, here's where a little bit of selling comes in, guys. I'll try to keep this brief. So imagine what things could be like tomorrow if you just had the right systematic strategies working for you, if you knew what to expect from your trading, if you had a process that was taking the right trades for you day in and day out without you having to sweat or suffer from analysis paralysis, something that I used to do a lot, I no longer do, or second guess whether you're making the right decisions. Instead, it was just putting in the required work day in and day out for you. It's just a process. How stress-free and easy would that make your trading and investing life? And as you ponder that, I'm just going to look at Graham's question. Good evening, Graham. Thanks for joining us. Graham says, thank you, Dave. Have you applied the system to other index constituent collections? I think you said dividends were included in the backtest. Maybe it won't make much difference to the system, unlike buy and hold, SPY, but have you backtested the system without dividends included? I have done a lot of those tests, Graham. Off the top of my head, I don't remember what the results were. It's something that I could look at. For our members of Systematic Investors Group, they actually do get a copy of the code for this strategy. For those that are part of our membership, our full membership. For those that are not, we offer the signals every day. You can get those, no problem. I don't know what the actual results are. I remember they were good, but a lot of the strategies that I tend to develop work well personally with the S&P 1500, and I think that's just I think it's just a function of the stocks that make up the S&P 1500. Like you've got the S&P 500, you've got the mid caps and some small caps. You have a good range of growth stocks and blue chip type stocks. And the strategies that I tend to develop just do well with the S&P 1500. The other reason that I use it is because you just get lots of opportunities, and that's really what you want. You've got a list of 1,500 stocks. There's opportunities, in this case, 70% of the time. With our 70% exposure rate. And I suspect it would even be higher, except that, we're using a regime filter. Okay, so Graham says, let's see. What details, personal banking, et cetera, need to be provided to set up paper trading at Interactive Brokers in Alera? So with Alera, you don't need anything. You can just download the software. With Interactive Brokers, if you have a full account, you have access to a paper trading account. If you don't have a full account, you can get access to a temporary paper trading account, but it's only valid for the day. If you actually go to, I'll show you where our website is later before the end of the presentation, and I'll show you in one of our FAQs at systematic-investors.com. If you look at our FAQs, it will tell you how to get let's see here. I think it's FAQ or FAQs. I've just put it in the chat box there. It will tell you how to get access to a temporary account. The problem with the temporary account is it'll allow you to test it for that day if you don't have a full paper trading account, but it loses connection when IB disconnects every night. So it won't maintain the portfolio from day to day. So it's probably better to get a full paper trading account. You can contact IB and ask them if they can do that. Now, before we get into questions, or any more questions rather, here's the link to access the free strategy scans. If you don't already have a free account, you'll need to set one up. So you'll just need to give us, your email address. Once you set up a free account, you'll be on our mailing list. You'll have access to the strategy scans for our 2 free systems. You also have access to our backtesting mini course, which is helpful, especially for those just starting out. So I'd also like to encourage those that are interested in systematic strategies to sign up for our low-risk 2-week trial of Systematic Investors Group. It's only $14.99. Gives you full access to our site for 2 weeks to evaluate it for $15. I mean, it's pretty much a no-brainer. So if you think of any questions afterwards, you can also email me at the email address as shown. And okay, so I'm happy to take any and all questions. Dan, if you want to turn on your mic at all, feel free to chime in to answer any questions so you can participate if needed. And if anyone else would rather ask their questions instead of type them in the chat box, just type mic in the chat box and we'll try to get to your question. We'll try to turn your mic on. Now let me just show you where you can get the signals. And before we do that, Graham, I'm going to show you where you can get the information. So if you go to our website at systematicinvestors.com, if you watch this video, it'll tell you how to get everything set up for the paper trading instance and to test your own automated strategy approach, get your own system set up. If you go to our frequently asked questions, Graham, you're going to see in here, okay, so how do I paper trade or paper test some automated strategies? How do I get a free paper trading account? All the information is there, so you can have a look at that. And you can see when you open TWS, it does have a try the demo without having to have a full account. Excuse me. So you'll need to install a full version of TWS in order to do that. Okay, and so for those that are interested in the free strategy signals, if you go to our link that says free daily trade ideas, you'll have to have a free account. You can pull up the daily signals for the RSI 2 and for the supercharged momentum trend. You can look at the backtest. I may need to update these, the backtest results. You can look at the APM strategy settings. So the current strategy settings right now, it will show you, how to set up the actual screen in Alera Portfolio Manager and all the things that you need to get started. Okay, and when this presentation is done, I will add another link here like I did here, how it works, strategy overview. Every strategy that we add is going to have a strategy overview. We also have pro strategies, and we actually just added a new strategy. I haven't announced it yet. It's a contributor series strategy from one of our awesome members, Dan. So he contributed to his strategy signals. He doesn't provide all of the code and everything like that and the strategy rules, but he is actually trading it with his own money, and he's allowed us to generate the strategy signals. That's available as if you're a full member. So you know where to get the APM settings. Here's what the strategy signals look like. These get posted at 4:30 every morning. Unless we have a server problem, then they might get posted around 8 a.m. So here's all the information you need. If you want to follow these strategies and you don't like automation, which I understand some people don't, here were all the buy scans for all the buy signals today. And here are all the sell scans. So if you're in a trade, you would have to look and say, well, am I getting a sell signal for anything that I'm in a trade? Alera Portfolio Manager will just go through, hundreds or thousands of signals and just determine that automatically. And that's why I like to use that. Okay, so that answers our first couple of questions. Let me just see if there's any other questions coming through. Let's see. Okay, Graham, we covered your question. Thank you for that. Ivor says, do you filter out stocks that are thinly traded? Now, I know a lot of people use turnover and different methods in their actual AMI broker code to filter out stocks. I use a very basic volume filter. And the reason why is because all of the stocks that I trade they're not thinly traded. I trade specific indexes. So the NASDAQ 100, the S&P 1500, the 15 largest companies practically in the world, the S&P 500, the Russell 2000, let's say. So I tend to use very simple volume filters. They're included in the AMI broker code. I don't get too complicated with turnover or anything like that, simply because of the nature of the indexes that I trade. So I hope that answers your question, Ivor. Jim says your reference to lots of opportunities is right on. This is the reason systematic trading works. Absolutely. And this is the reason why this strategy works. Because if you're a discretionary trader and you get like a string of losses, I tried trading moving average crossovers when I was a discretionary trader, and forget it. It just didn't work. Now, if you're a systematic trader, you just let your process and your system work, and it's a numbers game, and the numbers work out. That's why I've been able to, trade this strategy as a profitable strategy, using a systematic approach and using Alera Portfolio Manager, Jim. So you're bang on there. So that was a link I put in there. I think is it Giancarlo or Juan Carlo says, I'm sorry if I got your name wrong. So he sent this privately. Is there AMI broker AFL for the two strategies, or is it only for APM? Okay, so when you join our systematic investors group and you stay beyond the trial period, you get access to basically everything we come out with. Now, the offer, I don't want to do too much sales here, but the offer is essentially, we give you everything and the kitchen sink. We give you access to all of our strategy scans. So every strategy that we develop, we make the scans available so that you can use Alera Portfolio Manager. We've got a marketing deal with Alera Trading. So we even give you an instance of Alera Portfolio Manager for 1 year at a massive discount, especially for the full version. And we give you access to the code for our 2 free strategies and the code for another strategy. And for some reason, I just can't remember off the top of my head. Sometimes when I go live, I have little moments of forgetfulness, so I apologize for that. But if you actually go to our site and you go to our offer, you'll see the free code that we do give you, the AFL code. The reason why we give you that is because part of our offer with Systematic Investors Group is also a trade. It's called the trade and the automated trading and investing course for AMI broker. So we give you all the code so that allows you, that basically gives you everything that you need to become a successful systematic trader and investor, whether you want to use our generated signals or not. So for those that don't want to do, like they're on board with systematic investing, they don't want to do their own strategy development. We provide the signals to all our strategies. And for those that actually do want to learn to develop their own strategies, we provide code templates, and these ones are included in that, so that you can, develop out your own strategies and run your own strategies locally as well. So I hope that answers your question. So Ivan says, I'm live trading the 2 strats for a couple of weeks now, and apart from one issue with APM, so far so good. Thanks for that, Ivan. I'm glad they're working out for you. Ivan says he sleeps at night not watching the market, so he lets APM do the work. I couldn't have said it better. And I swear, guys, I didn't pay Ivan to say that. Ivan's one of our members. I appreciate that, Ivan. And that's exactly why I do this as well, because I'm actually, a very emotional trader. When I do things myself, when I manage the trades myself, I'm a very emotional trader. I'm not a very good trader. Like, I mean, I'll put it to you that way. I'm not a very good discretionary trader. I'm a decent analyst. I know how to analyze charts. I've been studying technical analysis for years. I use quantitative technical analysis in my strategy development processes. That's mostly what I use right now. That may change, but that's mostly what I use right now when I'm programming my strategies, mostly in AMI Broker. But I'm not very good with the execution part. I'm not a good trader. So for me, if I didn't discover how to become a systematic trader, become a systematic investor, if I didn't learn how to integrate all my strategies using a process and using tools like Alera Portfolio Manager, like APM, I don't think I'd be doing this anymore. I have to be honest with you, I wouldn't. And I became so excited about it that I could actually make this work, that I decided, to start Systematic Investors Group, to ask the guys at Alera Trading if I could promote their software to my community, because to me this has been a lifesaver. I'm all about multiple streams of income. I invest in real estate. I invest in other businesses. I invest most of my time in this business to share, with other systematic traders and investors. Trading and investing is another income stream for me, and I wouldn't be able to have that income stream if I couldn't get the process under control. So thanks for kicking in with that as well, Ivan. I appreciate it. Okay, guys, are there any other questions? So we've been going for about an hour and 15 minutes. If there's any other questions, I'm happy to take them. If there's no other questions, I'll leave the chat room open for a couple of more minutes. If there's no other questions, I'll wind the meeting up and start burning the recording. For those that want to catch the recording, obviously I'll make it available probably tomorrow. We're also going to send out the notification for the Alera webinar with the guys at Alera Trading tomorrow. So hopefully we don't bombard you with too many communications, but stay tuned for that. You'll need to register for that as well. Okay, so let's see. Jim says, thanks, Dave. Thank you, Jim. I'm glad you enjoyed it. I hope it helps. And when we see each other in person, we can talk more about this as well if you have any specific questions. Graham says, thanks, Dave. Thank you, Graham. I appreciate that. Another great presentation. Your presentation wasn't so bad either a little while ago. That was a really good presentation. Giuseppe says, thank you. Thanks for joining us. Appreciate it. Doug says, thanks, Dave. Stay safe. You too, Doug. I hope to see you in September, by the way. Wayne says, thank you, Dave. Very much enjoyed the presentation. Thank you, Wayne. Hope to see you in September as well. Ivan says, good stuff, Dave. Thank you, Ivan. Appreciate you being a member of our community as well. Giancarlo, I'm sorry if I'm getting your name wrong, if it's Giancarlo or Juan Carlo, says, thank you very much for the presentation. Thanks for joining us. Rick says, great, thanks. Thank you, Rick. Faiz says, thanks, Dave. Enjoyed the presentation. Thank you, Faiz. And I'll look forward to chatting with you on Monday about the APM stuff. Okay, guys and girls. Steven says, thanks, Dave. Great stuff. Thank you, Steven. Okay, so it doesn't look like there's any more questions. I appreciate the positive feedback. And just so you guys know, I have very thick skin. So if anybody has any negative feedback, I'm happy to hear it as well. I'm not one of these guys that just thrives off of positive reinforcement, positive feedback. If we have any blind spots, any way we can improve, you let us know. Even if you don't want to call me out in the chat room, which I appreciate you not doing. But I'm happy. I'm happy to hear your thoughts. Good, bad, or indifferent. Feel free to send me an email as well. If there's areas that you think we can improve, if there's areas you think we can help you in, because we've got a lot of stuff that we're coming out with in the future. If there's areas you think we can help you out in and we just haven't done it, or it doesn't look like we're doing it, just let us know. We're happy to help. Okay, I sound American. That's funny. I do sound like, I always wondered, except for, I say a lot, but I've always wondered how it is that I sound like the same people that I see on American TV shows. But whenever I meet an American, they always sound way different than me. So I'm not quite sure how that works. Thanks, Ivan. I appreciate that. It's a good laugh. Okay, gang. So you guys could have been anywhere tonight, but you chose to be with us on this beautiful Thursday summer night. I appreciate it. You could have been anywhere. So again, recording will go out. Appreciate you joining us. All the best and good luck, or not good luck, good statistics with your systematic trading and investing. So may the trading gods be with you. May the edges be with you. Look forward to seeing you guys on the next presentation. All the best. Sorry, I was just reading Steven's comment. Ivan, it's like calling you a Kiwi. That's funny. Okay, gang, all the best. Look forward to seeing you soon. Good night.